Hey everyone, this is Mayhem Talking Markets on Tuesday, February 1st, 2020. Looking at a chart that is a 10-minute time frame of the March S&P contract. And I just want to break something down that happened today so we can take a look at the price action that followed. And really, we see this area just above 4,500. Let's call it 45.10, 45.15. That was a really important area to climb above. It was where there was a lot of liquidity. And we also had 4,500 as well as a zone where there was a lot of liquidity. And so once the market was able to decisively break above 4,500 and then 45.15, we saw this really big move higher. There really wasn't much resistance above there. There was a little bit at 45.25. The market was able to push through that area after just a little bit of congestion here and then move all the way to 45.50, especially after those Google earnings gave the sentiment and buyers just a little bit of extra confidence. And I think that overall, we did see some signs of a potential double bottom in the S&P that we saw play out over last week and into this week with continuation. Once we confirmed a close above 44.20, that was a good sign for the rest of the market to really start to rally. We saw the rally broaden out from there. There's been better breadth and upside participation. So really this 42.60 area is an area to watch closely in the weeks ahead. That was where we sort of bottomed in the January sell down, and we've rallied off that level pretty well. It looks like we're up almost about 300 points on the S&P from those lows. So that's noteworthy. It also shows that, when we look at different indicators for the market, we're no longer oversold. The New York McClellan oscillator, New York Stock Exchange McClellan oscillator, I should say, is well into positive territory. So is the Nasdaq McClellan oscillator. So everything looks like we're going back into positive breath, which is a good sign. I mean, we could certainly see continuation from here. But if indeed this was just a relief rally and nothing more, then that overbought condition has been relieved, and that's something to watch. We did have a lot of talk about, these large outflows from ETFs. I don't think they're quite as noteworthy as it has been suggested, only because the amounts might be larger than what it was during the dot-com bust, but the price of the ETFs is much higher. So every unit that you're selling, even if you're selling less units, each unit has a higher price than it did back then. So it means that the distributions aren't quite as large as maybe the headlines lead one to believe. And also today's money is worth less than, the money of 20 plus years ago. So that's another thing to factor in when you're looking at those comparisons. So there's a little bit of fear out there, I would say, for certain. I wouldn't necessarily say that we saw capitulation. I don't think we saw quite that level of selling pressure or fear in the market, or really any disorderly selling at the broader index level that would have led me to believe that we're going through a capitulative phase. But we certainly had fear built into volatility. That all had an impact on price discovery to the downside, and we've been able to reverse that. We can see, when Powell had his press conference, things really got a little bit bent out of shape. That was when bonds got really volatile and rates started to surge on the 2-year. It had a 12 bips move. That was a 2 standard deviation event. That was the largest move in the 2-year note since March of 2020. And, now we can kind of see that sort of post-Fed pessimism was retested, and the market was able to find its way higher. We also had some Fed speakers out that have sort of suggested they might meander the path of rate hiking with more sensitivity towards the economy than maybe they had suggested pre-meeting. So it feels like they've walked back the hawkishness just a little bit, probably because they acknowledge that they don't want to completely destroy sentiment in the market. One of the things that's important to understand about central banks is that they do try to effectuate policy outcomes through jawboning and trial balloons, because they can pull those sentiment outcomes forward and have a more immediate impact on financial markets and the economy. So when we see the Fed doing this stuff, we got to understand they're trying to calibrate their policy, they're trying to gauge market reaction, they're trying to pull outcomes forward, or any combination of those things together. And so, right now, I think overall the market looks pretty healthy. It's certainly not a situation where I would say we're completely out of the woods, but it is a situation where we've had a nice technical reversal. We are starting to grind our way higher. We're above that important psychological level of the 200-day moving average, which is helpful. I don't think we need to put a lot of stock in that average, other than to say a lot of other people look at it, and therefore that makes it pretty important. But as you can see on my chart here, really a lot of the The resistance existed at that 4,500 level. That was also a wall of calls last week that we were grinding through, and that was still an area of a lot of open interest today. When I looked at the stacked open interest over the next 7 months or so, there's still a fair amount at that 4,500 area. There's also a pretty good amount at 4,600 and 4,700. It's a really, really large area of open interest across calls. So we'll have to see what happens in the days that go on. We've got a lot of earnings and macro data to go through this week, including unemployment and non-farm payrolls, including Amazon, Meta. So let's watch and wait and kind of see how everything goes before we necessarily conclude that all the worst is behind us. But I'm at least cautiously optimistic that in the short term, we've seen an interim bottom put in on the S&P 500, which again, we can kind of see at this chart around that 4263, 4266 level. I would not want to see prices cross below that on a closing basis. That would tell me that there's probably more selling to come. So, keep an eye out. Don't necessarily get too deep into positions. When you go further back on this chart, you can see we're starting to enter an area of a lot of congestion between that 4550, 4560, 4580, and 4600 area. So this whole area here could be an area where we chop along and try to break higher, and we could even see some resistance there and get reflected back downwards. So there's no certainty yet, although the bulls are starting to take control of price action. We've had three plus days in a row with pretty good breadth on the turnaround today from the morning selling. So that's good. We had the volatility fall to about 23 today. That's good. We haven't seen the move in tech confirmed by bonds, so that's a little bit concerning that we haven't seen the NASDAQ and the 30-year bond chart really see the correlation that they've had previously. That doesn't mean that the move isn't real. It just means it hasn't been confirmed, and it doesn't have to be confirmed, but it helps my conviction to see it confirmed, because a lot of these stocks are rate sensitive, and ultimately higher rates can hurt their upward price discovery. And it can also end up hurting their earnings, because some of them are leveraged, others are simply not producing cash. They're not able to pay their own expenses, so this could increase the chance of more expensive debt financing. And so we do want to keep an eye on those rates, especially as real rates lurch into positivity on the longer end of the yield curve. So until next time, this is Mayhem signing off. Talk to you soon.